The four most dangerous words in the English language are, "This time is different." Or is it really? Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is August 1st, 2023. The phrase, "the four most dangerous words in the English language are, this time is different," are attributed to two people. The English economist John Kenneth Galbraith and the money manager Sir John Templeton. When that phrase is used, it is used in connection with bubble-like territory, bubble-like perception that the stocks seem to be going to the moon. And I think of the time, the time that is most pronounced in my brain is 1999, or particularly the last half of 1999. I remember that. And stocks just seemed to be going up and up and up a lot. And the phrase, "this time is different," meaning, no, it's not going to collapse. Maybe it will go to the moon, or it'll go up so much we can just relax about the risk. And we know what happened after that. The stocks, particularly those that were going to the moon, collapsed. Most of them went out of business. They went to zero. A lot of them went down 70, 80, 90%. And that followed the euphoria when they just were going up and up and up and felt like they were going to the moon, and it felt like this time is different. We've entered a new paradigm. We've entered a new era of internet stocks and the technology, and the old economy is behind us. I went back and looked at some time periods that were bubble type territory. And you could say that about these. This time is different. This is actually going to work. And we look back now and maybe scratch our heads and think, how could I have ever thought that? This is crazy. But we go all the way back to 1600 in the tulip bubble, tulip mania. And I won't go through that. You probably know about it. The South Seas bubble in 1750. The railroads that were emerging, that were this new way of opening up America, and it was somewhat like the technology is today. That was the technology of the mid-1800s. And the late 1920s euphoria. And we know where that ended. And the technology bubble in 2000, and the real estate housing bubble in 2008, and those more are in our recent past, so most of us remember those. But the crashes that occurred then, or right after then, were preceded in all cases by euphoria, when they just went up and up and up. And so as I read about the AI and the influence on the stock market, and these stocks are up, 50%, 100%, 200%, whatever, they're going to go to the moon. And the valuations are crazy high. And I'm thinking, I come back and I think about, I've heard this song before. This sounds very familiar. And I think of times like this. I saw a couple of charts I wanted to show, and this illustrates my point. So the stock market is going up, but it is led by technology stocks, which is led by AI. So when you pull AI stocks, in this case 7 of them, this would be Apple, Microsoft, Google, Amazon, Tesla, Facebook, Meta, and NVIDIA. So when you take those 7 stocks and isolate them, the market looks very different. And that's the way bubble territory or bubble periods are. Again, I think 1999 was an exaggerated version of this, but they're all like this. They're just a different group of stocks each time. So what this chart does is it breaks them out. It takes those 7 and says, let's look at a composite of those 7, and let's go back to the beginning of January and look at the performance of those 7 compared to the rest of the market. Down below, the blue line is the large cap stocks, that's the S&P 500, and the red line are the small cap stocks, the Russell 2000. So you see the divergence, the incredible pull that the technology stocks, and in particularly the AI stocks, or those that are investing heavily in AI, have on the market. You can see that the rest of the market is not participating. Again, very much like 2000, but also like other periods where there were crashes. I'm not saying this is going to crash or it's going to crash right now. I think it is going to pull back. It may result in a crash. These are so overvalued that when there is a pullback, it makes them more at risk. Anyway, that's what's pulling the market up. It's not the underlying economy. It's not the underlying stocks. It's 7 stocks mostly, and they are so it is providing a lift to some other stocks. But when you pull them out, it looks very different. This is another way to look at it. If you took the S&P 500 and the S&P 500 is an index, and it is weighted. It's weighted toward the larger components of the index. It's called a weighted index. The larger the company in the index, the number 1, Apple, Google, etc., on down, those at the top get the higher weighting, and vice versa at the bottom. You can see the red line shows the market cap weighted index. This is what the S&P 500 looks like with everything in it on a market weighted basis. It's just the way it is. If you change that weighting to an equal weight so that the 500th stock gets the same weight as the number 1 stock and everything in the middle gets the same weighting, the black line is what you would get. So that tends to show us more what the market itself looks like versus the component that is so heavily weighted toward, in this case, companies that are heavily influenced by AI investing. Back in the 1990s, I remember this guy. His name is Henry Blodgett. You may know him. He's not real well known, but in some investment circles, people know his name. In the 1990s, he developed a name for himself. He was, in his career journey in the 90s, he was the global internet analyst for Merrill Lynch. And I remember the time in 1999 when he came out and he was so enthusiastic. He was almost hyping the technology stocks. At that time they called them .com, but the technology stocks of that time. And the NASDAQ ended up going to, I believe it was 5,000, around 5,000. And he made the statement, I remember hearing this, that he said, the NASDAQ is going to 50,000. It was 5. It's going to go, and it had already been hugely elevated, and I'll call that going to the moon. It's going to 50,000. Well, right after he said that, the market crashed, and the 5,000 value of the NASDAQ went down to 1,000. It lost about 80% of its value. He has a track record that's not very impressive, and he tends to jump onto things that are trending. He got in trouble with some fraudulent activity, and he's now barred from trading securities for the rest of his life. But I remember that period of time where he was jumping on the bandwagon, and you know, you could say, okay, that's Henry Blodgett. Okay, I'm not that guy. Okay, true, but there's part of that thinking in the market where there's part of Henry Blodgett in a lot of people, that when things are going up and up and up, people are thinking, I want to get on board. I don't want to miss out. I want to participate in this rally. And what happens oftentimes is the market continues to go up. It continues to validate that thinking, oftentimes, until it doesn't. And that's the key word, until it doesn't. And anyway, I think the lessons from Henry Blodgett are, when you see something that's going like this, the steeper the incline and the longer the incline, the more you know this is not going to the moon. This will correct. Now, as I look at this market, I say it is a positive market. The market is in an uptrending mode. We have been participating most of this year in that rise. We got in January, and then got out in part of February and March when the market pulled back, and then we got back in, and I think we've stayed in, I think, the rest of the entire time since then. And so we have participated in it, and we're still invested in the market, and it looks like it is going higher, but I don't believe that it's going to the moon. And because we're tactical managers, we are prepared that when the market turns the other way, we have a methodology to get out, and we will get out. And when the market is at its bottom, we have a methodology to get back in as soon as possible, and we will do that. And that's tactical management. But as long as it wants to go up, I'm okay with it. But I'm not buying the thinking that it's going to the moon, or that I need to get on board and stay on board. And, you know, crypto, for example, had that phenomenon over the last several years. 2 or 3 times that it went really, really high, and it was going up 5 to 10% a day. And you may remember that. And it kept going, and it pulled people in. People were, in my opinion, suckered into it. And when Bitcoin got to 40,000, 45, 50, 60,000, people were saying it's going to 100,000, it's going to 200,000, 250,000. And it got to 65,000, and then it collapsed. And the last time, it came all the way down to 16,000. 65 down to 16. It lost about 75% of its value. But during that last phase, that euphoric phase, that's when it sucked in people who were afraid they were going to miss out and was going to go to the moon, and they got slammed. So that's what I see. Very similar to the thinking in the 90s of Henry Blodgett. Same thing with Bitcoin, or you could say the same thing with Tulip Mania or whatever. But that's what happens. So my comment to you is, yes, it's going up. If you have been invested and you participated in these gains, good for you. I would say be careful. Be careful. It's up to you. I'm not going to give you investing advice, but think about the idea of, do you want to have a method to get out? When do you want to take those profits and then wait for another time to reinvest? Or if you're sitting on the sidelines and you have cash, entering the market now, in my opinion, is high risk. And so it was high risk a month ago. And you could say, well, I missed out on some gains this month. Heck, next month it could have gains also. That doesn't mean that I'm wrong. It means that at that time, it is a more correct statement than today. When you take the longer view, I think you will see that what is going up that's too elevated will in fact come back down. I don't mean it's going to crash to earth, or that, a 5 or 10 year view might not work. It's just going to be a very rough ride if you think of where you are today in an elevated position, that's going to last. And just think about when you want to take profits. How do you want to do that? Several years ago, I had the privilege of meeting Med Jones. And Med Jones is an international economist. He's does a lot of business, has lived in Europe a lot, and does business in Europe and Asia and the U.S. He now has his headquarters in the U.S. And in my research, I came across one of his quotes, and then had the privilege of meeting him. I reached out and we developed somewhat of a friendship. And but he said something looking back on 2008, just one period of time. What happened? What was the thinking that went on prior to 2008? Now he's an economist, but from, I think, more of a sociological perspective, he made this statement, and it so accurately describes from that perspective what occurred in 2008. So I just thought I would play it. I think each time is different. So yes, this time is different, but it's also the same. Every time has similarities and differences, but to say it is so different that it's not going to correct, I think is making a wrong assumption. So this is what Med Jones said following the 2008 collapse. And I've read this before, so bear with me if you've heard it before, but I think it's kind of apt when I think of AI, even if it goes on up from here, which I think it probably will. I think this still has some application. So this is what Med Jones said. There are two main reasons that caused mainstream economists and financial media to miss the financial crisis of 2008. The first is the NIH bias, not invented here, which is an organizational phenomenon manifested as an unwillingness to adopt an idea because it originates from unknown outsiders. In other words, I didn't think of it myself. It is a form of social cognition bias that leads to errors in group judgment, such as missing on new opportunities and risks. The second reason is a cognition bias known as the confirmation bias, which is the tendency to search for, filter in, or interpret information in a way that confirms existing preconceptions. The confirmation bias is recognized as an individual cognition bias, but when met with NIH bias, it appears to develop into a social bias very similar to the groupthink syndrome. Very well and correctly stated as we look back on that period of time. I want to shift gears, and I want to give you an optimistic view of the market. You see, if you listen to me, you know that I'm cautious, that I'm not a big risk taker. I don't tend to look for things that are high return / high risk. And so I'm looking for where is the flaw? Where is the risk in things? So as such, I have an orientation to being cautious. So, however, I think of myself as more of an independent thinker and neutral. So when the market is going up, like I said earlier, we are participating and have participated in this market. I'm glad to do that. That's how you make money. But I'm also not so locked into it that I am willing to ride it all the way down when that time comes. And that's where I depart from my peers, who I'm going to say 95%, at least 90, maybe 95%, believe in the methodology, and you know this if you've been in investing, who believe in the methodology of, yes, you write it up, but you write it all the way down. They don't say it that way, but that's what they do. They write it all the way down, no matter how far it goes. They say things like, you can't time the market. You can't sell now. I didn't see this coming. Things like that, as a way to excuse it. And then they start talking about, well, by next year the market will be up. They always have this orientation for the market's going up, and meanwhile, you've seen this. You saw it last year. Meanwhile, you lose a lot of money. Some people get wiped out. I've seen that. And so I don't think that way. But I do want to show the positive side, because there is a positive side to the market right now. And so this, I'm going to show you 3 clips. They're very brief. And they begin with people who do have an orientation to that. But I think their information is correct and valid, at least for right now. I'm going to begin by playing a piece. Scott Wapner interviews Professor Jeremy Siegel from the Wharton School, distinguished professor who's highly regarded, and he tends to have an optimistic bias, but that's okay. I think what he's saying is correct. So take a listen to Scott Wapner and Professor Siegel.
Whether there's enough momentum in earnings so far to keep this rally intact. Let's ask Professor Jeremy Siegel of the Wharton School. He is live with us once again. Professor, it's nice to see you again.
Good afternoon, Scott.
We heading towards new highs, Professor?
I think so. I mean, this is such a strong market. You hear the guidance from the firms that was so tentative, in the first and second quarter. A lot of it is so much more confidence. The internals are improving. It's broadening out. The ECI, that employment cost measure that Chairman Powell mentioned a couple days ago, came in below expectations, as well as the others. Goldilocks, lower inflation and stronger economy, and good guidance and good profits. What's to stop this market now?
I don't know. Jay Powell and company, maybe. You think they're done?
I'm not sure that they're done, but what I'm pleased about is that he acknowledges that there are two-sided risks, that he's going to, every meeting is a live meeting. There's no preconceived motion about whether they're going to go up or down. They're going to look at the data, which is something that, I've urged for quite a while. Frankly, as you know, when I saw the money supply go down, decelerate by the greatest amount in history, I was concerned. I was worried about what was going to become of the economy in the second half. And I'll tell you, the first half, I don't know anyone who thought that the first half would grow faster than 2%. I would look back in my records, even the Fed was way below that in its estimate. So inflation coming down, stronger economy, I don't see this stopping anytime soon.
Next, Andrew Sorkin from CNBC interviews Stephanie Link from Hightower, and she also tends to have an optimistic view, kind of a stay invested kind of view. But I think what she's saying is valid, and it is the positive side. So if you're looking for information to support being invested or staying invested, she would validate that. As I said earlier, if you're sitting there with money and you're looking to come into this market, that's where I would put caution in to say, at least be very careful. So here is Andrew Sorkin and Stephanie Link.
It's been a very busy earnings week. I mean, this has been something. So now the question is, where should you be putting your money to work? I want to bring in Hightower Advisors portfolio manager and CNBC contributor Stephanie Link. What a week it has been. We thought we might get, one of the great streaks of all time. We lost it yesterday afternoon, but on a relative basis, it's still quite remarkable. The question is, has the train gone too far or still hasn't even left the station?
I don't think so, Andrew. I mean, I think that the economic data that has been coming in is certainly supportive of a soft landing, at least for now. right? And we talk all the time about the consumer. The consumer has been resilient because jobs have been so strong. Wages are up. You're seeing autos recover. They're up 16% year over year. Housing is back to highs that we saw last year. Services is strong. I think PMIs, by the way, have also bottomed. So it's a soft landing. And we saw that in the GDP number yesterday at 2.4%. And that's translating into decent earnings. Earnings so far, 44% of the companies have reported, 80% are beating. And they're growing earnings overall about 3%. That's much better than what people were thinking. People thought we were going to be down 5 to 10%. So we have a long way to go, but so far, so good.
And then finally, I'll play this piece from Bill Baruch. He is a little bit more of a balanced view. He's optimistic, but he's also cautionary, talking about that we're probably headed into a period of some kind of a downturn or correction. And I think that I like the way he said this. He said, this is going to remain a bull market until it isn't. That's a very good statement. It's going to keep on until it isn't. But the key is to know when it isn't. And the other key is in what are you going to do about it?
Nothing that happened this week changes the narrative that the trend is up until it's not, and that good enough earnings are good enough for now.
Yeah, it's a bull market, and it's been a bull market really all year. I'm going to echo what Jim had just said, and I've been talking about this the last couple of times on the show, is, August to October, I have a little bit of fear we have a pullback. And I don't think it's going to derail the overall rally. I think we could finish the year at record highs. But I want to be prepared for that pullback. I've trimmed a little bit and kind of get ready for that. But what really pointed out of the week that I thought was most important was the GDP data yesterday. We're not talking soft landing anymore. We're talking no landing. And so my fear would be looking at the Fed watch tool, the CME's Fed watch tool, the odds of a hike in September are only 20% today. Yesterday, they were nearly 30%. The soft PCE data and ECI today brought that down a little bit.
It's like 1 in 3 now for November.
Yeah.
How'd you get the approval for all this? Well, I just told them the name of the project. Thank you for watching. If you have questions or comments, leave them in the comments section below. Thank you.